Welcome to this deep dive. Today we're unpacking Nordson Corporation's second quarter results for their fiscal year 2025.
That's right. We've got the earnings release, the call transcript, everything we need.
And our mission, as always, is to pull out the key insights, the really important takeaways, to get you up to speed quickly on Nordson's performance and what they're signaling for the future.
Let's jump right in. Nordson's Q2 ended in April, and overall, they landed slightly above the midpoint of their guidance, both sales and earnings.
Okay, good start. Let's get the headline numbers compared to last year. Sales first.
Sales hit $683 million. That's up 5% year over year.
But that 5% needs a closer look, right? Because the Atreon acquisition played a big part.
A very big part. That added 8% to the top line. So if you strip that out, organic sales were actually down 2%.
Okay, down 2% organic. Any currency impact?
A small one. Less than 1% negative impact from currency translation.
Got it. So acquisition-driven growth overall, how did profitability look? Gross profit?
Still very healthy. $374 million, which works out at 55% of sales. Pretty consistent, strong margin there.
And adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization, adjusted for certain items.
Right. That came in at $217 million. That's 32% of sales. And importantly, it was up 7% from last year.
So EBITDA grew faster than sales. What drove that?
Well, a couple of things. They mentioned improving incrementals, basically, how much profit they make on extra sales in their advanced technology segment. And that Atreon acquisition, it contributed more strongly than they initially expected.
Okay, makes sense. And the bottom line, adjusted earnings per share, EPS.
$2.42 per share. That's up 3% year over year. And like overall sales, just a bit above their guidance midpoint.
What were the moving parts for EPS?
Mostly good conversion on those higher overall sales, plus a little help from a lower tax rate. That was slightly offset, though, by higher interest expense.
Which makes sense, given they financed the Atreon deal.
Exactly. Acquisition-related interest expense ticked up.
And how about capital deployment? What did they do with their cash?
They were pretty active. They bought back $85 million worth of their own shares in the quarter.
Okay.
Paid out $44 million in dividends. And their balance sheet looks solid. Leverage ratio ended the quarter at 2.4 times, based on the last 12 months EBITDA.
And that 2.4x is right within their target range, isn't it?
Yeah, their stated target is 2 to 2.5 times, so they're right in the middle of that. Comfortable position.
All right, so that's the big picture snapshot. Outperformed guidance, slightly, driven by acquisition, solid margins. Now let's really dig into the segments to understand the underlying dynamics. First up, Industrial Precision Solutions, or IPS.
Right, IPS. This segment saw sales of $319 million, which was actually down 8% compared to last year.
Okay, down 8%. How much of that was organic?
Most of it. Down 7% organically,
Right.
and then about a 1% drag from currency.
What caused the organic decline in IPS?
The main issue was weaker demand for their larger systems, specifically in industrial coatings and polymer processing product lines. It seems end market demand there was just lower. Customers holding back on bigger investments, maybe.
Yeah, that makes sense in the current environment for some industrial sectors. But was it weak everywhere in IPS?
No, not entirely. They did point out some bright spots. Non-woven systems had growth, and precision agriculture was actually a standout double-digit growth there. Packaging product lines also performed reasonably well.
So a mixed bag within IPS. They also mention a manufacturing move.
That's right. They've been transitioning their industrial coatings manufacturing to a new plant in South Carolina. They said that move is now substantially complete.
And looking ahead for IPS.
The expectation is for continued sequential improvement. So quarter-over-quarter growth as the year progresses. Profitability, the EBITDA margin, was 36% of sales. That's down a bit, which you'd expect with the lower sales volume impacting leverage.
Okay, let's shift gears to the second segment. Medical and Fluid Solutions, MFS. This is where that Atreon acquisition really shows up.
Absolutely. MFS sales were $203 million, a big jump, up 20% year over year.
And Atreon's contribution...
It was $51 million in revenue for the quarter. So you can see that's the overwhelming driver of the segment's growth.
But there's a nuance here, isn't there? Because even with Atreon, some parts of the legacy MFS business saw declines.
That's a key point. They saw double-digit declines in their medical interventional product lines. And importantly, this includes their medical contract manufacturing business.
Yeah, right. The business they've signaled they're looking to exit.
Exactly. They've been deliberately rationalizing that part, getting it ready for sale. So if you actually pull out that contract manufacturing piece, the remaining MFS organic sales are down about 4%.
So that 4% decline reflects the continuation of those inventory destocking trends we've heard about in medical devices.
Precisely. Destocking, particularly in those interventional products. However, they did say they're seeing sequential improvements quarter over quarter, which they feel validates their view that these destocking headwinds are starting to lessen.
Any other parts of MFS showing strength?
Yeah, the fluid components business, which is a smaller piece, had been down for a while, but is now showing, quote, nice growth. So that's turning positive.
And MFS profitability? EBITDA.
Very strong. $77 million, hitting 38% of sales. That's up 22% year over year.
Wow, 38% margin. How did they achieve that despite the organic dip in parts of the business?
It really came down to strong profit conversion on those Atreon sales volumes, plus just solid operational execution on the organic side, managing costs effectively.
Now, you mentioned the contract manufacturing business being rationalized for sale. Any update there?
Yes, big news on the call. They've signed an agreement to divest select product lines within that medical contract manufacturing operation.
Okay, so it's happening. What's the strategy behind this divestiture?
It's clearly about focus. They want to concentrate the MFS segment on what they see as higher value growth opportunities.
Which means?
Primarily their proprietary medical components, and that now includes the devices they got through the Atreon acquisition. Selling off the contract manufacturing lines allows them to sharpen that focus.
What impact do they expect this divestiture to have?
They believe it will improve the overall growth profile of the MFS segment. And importantly, it should be accretive to margins once the deal closes.
Accretive means it should boost the segment's margin rate.
Yeah, they estimated roughly 100 basis point improvement to the segment's margin on a full year basis post-sale.
Significant. And when might this deal close?
They're targeting a close in the fourth quarter of this fiscal year, so sometime later in calendar 2025.
How big is this piece they're selling?
It represents about 4% of MFS's year-to-date sales. So not huge, but strategically important for focus.
And they framed this as part of a bigger process, right? Using their NBS Next system.
Exactly. They emphasized this is part of their ongoing portfolio analysis. They use NBS Next to look at things like market attractiveness, how differentiated their products are, financial performance, and they make decisions based on that.
So pruning the portfolio to drive better performance, are other divestitures planned?
They didn't mention any other specific actions currently underway, but they did stress it's an ongoing process. The goal is always to make sure their teams are focused on the best strategic growth areas.
Okay, very clear on MFS. Let's move to the third segment, Advanced Technology Solutions, ATS. This one looked like a real growth engine this quarter.
It definitely was. ATS sales came in at $161 million, which is up a strong 18% year over year.
And what drove that 18% growth? Was it broad-based?
Yes. They described it as broad-based. They specifically called out double-digit growth in electronic dispense systems, optical inspection, and X-ray inspection systems. They also mentioned a strong backlog and steady order entry, suggesting continued momentum.
What end markets are fueling this ATS demand?
It's heavily tied to semiconductor and electronics applications. Think about all the investment going into computing power right now.
Yeah.
AI, cloud data centers, e-commerce infrastructure.
Right, needing more and more complex chips.
Exactly. And Nordson's equipment plays a key role in manufacturing and testing those advanced semiconductors and electronic components. That's driving solid demand.
The profitability in ATS also jumped significantly. EBITDA margin.
Huge improvement. EBITDA was $40 million, translating to a 25% margin on sales. That margin percentage is up 43% compared to last year.
Wow. What's behind that big margin expansion?
It's a combination of factors. The higher organic sales volume provides operating leverage. They also pointed to disciplined cost management and manufacturing efficiencies they put in place. They seem to think these margin gains can continue as volume grows.
Now, ATS is known for being cyclical, kind of lumpy, right? Tied to those big investment waves in semis and electronics.
That's absolutely true. It's inherently lumpy. Customers in these industries tend to expand capacity rapidly, then maybe pause, then expand again.
So where does Nordson see the ATS segment in the cycle right now?
Their view is that they're starting to grow again. The order entry trends and the building backlog support that. They seem confident the current cycle is moving upwards for them.
And longer term, through the full cycle.
They reiterated their view that ATS should be a 5% plus organic growth business when you average it out over the ups and downs of the cycle.
Any particular geographic strength in ATS currently?
Yeah, they mentioned that most of the current growth they're seeing is coming from customers in Asia.
Interesting. What about all the talk of semiconductor investment in the U.S., like through the CHIPS Act?
They see that as still mostly future upside. It hasn't fully translated into orders for them yet, but it represents a potential tailwind down the road.
How are things like tariffs or customers shifting manufacturing locations impacting ATS?
Interestingly, they framed customer footprint adjustments as an opportunity. Because Nordson has a relatively capital-light model and operates close to its customers globally, they feel they can pivot quickly.
So if a customer moves production, Nordson can follow.
That's the idea. They mentioned expanding their own capabilities in places like India, for example, to support customers there. Their agility is seen as a strength in this dynamic environment.
And innovation must be key in ATS.
Absolutely critical. They stress the need for high investment in R&D here. They mentioned new products like the WaferSense sensors that came with the CyberOptics acquisition as examples of how they innovate to solve complex customer problems and stay relevant at the leading edge of technology. That's essential to capture growth in these fast-moving markets.
Okay, let's switch back to the overall company finances. Balance sheet and cash flow, give us the rundown.
Sure. They finished Q2 with about $130 million in cash on hand. Net debt stood at roughly $2.1 billion.
And leverage we mentioned was 2.4 times. Did that change much?
It actually came down slightly from the end of their last fiscal year. So, heading in the right direction and comfortably within their target.
How about free cash flow generation in the quarter?
Free cash flow was $13 million. That was pretty much in line with the same quarter last year. It represented a 92% conversion rate from net income for the quarter itself.
And year to date?
Even stronger. Year to date, their free cash flow conversion is sitting at 116% of net income. So, generating good cash.
We talked about share buybacks and dividends. How did they describe their capital allocation priorities in Q2?
Given the market backdrop, they explicitly said they prioritized share repurchases over paying down debt more aggressively in the quarter. So $85 million on buybacks. They also continued their dividend payments and invested back into the business about $16 million in CapEx, which included spending on that new IPS facility in South Carolina we discussed.
Got it. Now, a topic that's always relevant, tariffs and trade policy. What was Nordson's commentary on the current situation?
Their message was that at current levels, the impact is manageable. They didn't see any material impact in Q2, and they don't expect current policies to materially affect their Q3 results either.
How are they managing potential tariff impacts? What gives them that confidence?
It really comes back to their operating model. They have that in-region for region manufacturing strategy, meaning they tend to produce goods close to where they sell them. Their decentralized structure helps too, as does being close to customers.
So they can adjust locally.
Yes, and they also mentioned using targeted price increases where needed and adjusting supply chains. They feel they have levers to pull.
Is there a bigger risk they're watching?
The main concern they voiced isn't the direct cost of tariffs hitting them, but rather the uncertainty it creates. The risk is that this uncertainty could cause their customers to delay big investment decisions, which would then dampen end market demand across the board.
So indirect impact is the bigger worry.
That seems to be the focus. They're monitoring the situation closely. There's potential policy changes that might come up later this summer, around July or August. They stress that staying agile is key.
They also mentioned some restructuring actions?
Yes, targeted actions, mainly in those parts of the business facing weaker demand currently.
What's the timing and expected benefit?
They expect these actions to be mostly done by the end of Q3. And the goal is to generate over $15 million in ongoing annual cost savings by fiscal 2026.
Okay, so looking forward, let's talk guidance. What did they project for Q3?
For the third quarter, they're guiding for sales in the range of $710 million to $750 million.
And for adjusted EPS?
The Q3 adjusted EPS guidance is $2.55 to $2.75 per share.
How does this Q3 guidance fit with what they expected for the full year?
They were clear that this Q3 guidance is consistent with the full year outlook they set at the beginning of the fiscal year and confirmed after Q1. No major changes there for the overall trajectory based on Q3 expectations.
But there's still some uncertainty about Q4.
Yes, they flagged Q4 as having more uncertainty. It largely depends, again, on those potential policy developments later in the summer and how they might ripple through to end market demand. They haven't seen a negative impact hit their business yet, but it's the unknown they're watching.
Despite those external uncertainties, it sounds like they feel pretty confident in their own positioning.
Definitely. They spend time highlighting what they see as their core strengths and sources of resilience.
Such as?
Things like having a strong portfolio geared towards growth markets, a high proportion of recurring revenue from parts and consumables, being diversified across different niche end markets and geographies.
Their close to customer model we talked about.
Their proprietary differentiated products, the NBS Next framework driving continuous improvement, and of course, that strong balance sheet. They really painted a picture of a company built to navigate different market conditions.
And positioned to capitalize on shifts like manufacturing moves.
Yes, they see that as an opportunity.
Yeah.
And they pointed to their history, how they managed through the Great Recession, the pandemic, as evidence of their resilience.
So bringing this all together for you, the listener trying to get informed quickly, why does drilling down into these segment details and strategic moves matter? How does it help you understand Nordson better than just the headline numbers?
Well, it moves you way beyond just sales up 5%, EPS up 3%. When you unpack the segments, you see how Nordson connects to major global trends. You see the direct impact of semiconductor investment driven by AI and cloud, boosting the ATS segment.
Right. And you see the M&A strategy playing out in MFS with Atreon driving growth, but also the strategic rationale behind divesting the contract manufacturing piece, optimizing for higher margins and focus.
Exactly. Understanding the specific pockets of weakness in IPS, like industrial coatings, versus the strength in precision ag, gives you a much clearer picture of the underlying business health than just the overall segment decline.
And hearing how they plan to manage risks like tariffs through their operational model or drive savings through restructuring it shows their strategic levers in action. It helps you understand the why behind the numbers, not just the what.
It connects the dots for you between broad market forces, the company's specific strategy, and how they're executing day to day. That gives you a much deeper understanding.
Okay, so based on everything we've dug into today, here's a final thought for you to consider. We heard a lot about Nordson's ongoing portfolio assessment using NBS Next, the successful integration of Atreon, and this strategic divestiture in MFS.
Clearly, active portfolio management is key for them.
So the question is, how might this continuous process of pruning businesses here, adding businesses there, impact Nordson's ability to consistently hit that stated goal of 5% plus organic growth through the cycle for the whole company? Especially given the inherent lumpiness we discussed in a key segment like ATS. Can this active management smooth out overall growth, or could it potentially introduce new kinds of variability?
That's an interesting question. Does constant tweaking help or hinder hitting that long-term average target? Something to mull over.
And with that thought, we'll wrap up this deep dive into Nordson's Q2 fiscal 2025 earnings call. Our aim was to distill those key insights and get you thoroughly informed from the source material.
We hope breaking down the results, the segment performance, and the strategic context provided some valuable perspective on where Nordson stands and where they might be headed.
Thanks for joining us. If you have other company results or topics you'd like us to dive into, please let us know.
Until next time.